Feeling anxious about the market volatility? You're not alone. But here's the good news. Some investing principles never go out of style. In this video, I'll cover 6 evergreen investment principles that have stood the test of time. Principles that will guide you through the ups and downs of any market. Whether you're a seasoned investor or just starting out, these insights will help you protect and grow your wealth over the long haul. Here are the 6 evergreen investing principles. 1. It pays to own stocks. 2. Pullbacks and even corrections can be expected. 3. Keep a long-term view to protect your long-term goals. 4. Non-recession bear markets are typically shallower and far more rare. 5. Market timers miss out. 6. Don't let your feelings about the economy torpedo your investment strategy. When it comes to funding investment objectives, history has shown that there are no better alternatives to equities in providing better potential for capital growth over the long haul. The market has overcome temporary setbacks and continues to march ahead. This is a great visual that encourages zooming out and understanding that U.S. equities have survived every setback, no matter how dire the situation may have looked at the time. If you're invested in the stock market, you're likely pursuing investment objectives that extend well past this year. Even note that it's paid to own stocks most years. The S&P has had an annual return of less than a negative 10% only 12 times dating back to 26. That's almost 100 years ago. The S&P has generated a positive return 74% of the years since 26, and about 60% of the returns have been 10% or greater. About 38% of the years result in returns of 20% or more. Even the best returning years for the markets have at least one inter-year decline, with an average inter-year decline of a negative 14%. This chart shows inter-year stock market declines. They're the red dot in the number, and the market's return for the entire year, the gray bar. It clarifies that the market can recover from inter-year drops and finish the year in positive territory, encouraging investors to stay the course when markets do get choppy. For example, in 2020, the market at one point was down 34%, but ended the year up 16%. In 2009, the market was down 28% at one point in time, ended up 23%. In addition, annual returns were positive in 33 of the last 44 years. Again, the longer the time horizon, the stronger your opportunity for higher returns. For example, over a 5-year rolling period, a 60-40 stock bond portfolio could return anywhere from a plus 1% a year to a plus 20% per year. Stocks and bonds can be much more volatile during short periods, such as a year. Many investors report worrying about the impact of the 2024 election on their portfolios, but I believe these fears are likely overblown. Across the entire ballot, there's not enough historical evidence to support investors voting with their portfolios rather than their personal and political beliefs. However, the policies implemented by the elected officials are important, especially with the next administration responsible for addressing the expiring provisions of the Tax Cuts and Jobs Act. Every election year of a president since 1944 has resulted in stocks posting gains for that year, regardless of who won. The average annual return of the U.S. equities in those presidential years has been 16%. Hey, don't let market volatility shake your confidence. If you're not hearing about these strategies from your advisor, reach out. Schedule a meeting using the link in the description and ensure your investment plan is built to last. Stay ahead of market trends and make informed decisions for your future. Together, we'll create a strategy that works for